So every day we talk with buyers that are working through the home buying process, and they've got a whole bunch of questions about what's happening, where they're at, what's going on with lender, what's going on with title. And we want to talk about kind of what the whole process looks like from the lender's perspective. We've kind of talked about what the home buying process looks like from the real estate side, but until we've kind of opened up Pandora's box and really looked at what it looks like from the lender's perspective, it feels like everyone's just kind of talking about like, oh, I don't know what happens. We're just here we are, and then we're kind of waiting for the next thing. So we've got Bethany. We're going to talk about what happens through the transaction from the lender's perspective, so that way we can kind of, get a really good idea of what's going on with our transactions. So thanks again for joining us, Bethany.
Yeah, thanks for having me again.
Yeah, let's talk about this because there's so much to it.
Behind the scenes look of what's going on, because there's a lot of stuff going on behind the scenes that you don't see as the buyer. So we're just kind of going to take you on a little journey of what you do to get from getting pre-qualified to, getting the keys to your new home.
Perfect. So let's talk about that pre-qualifying process, when from the lender's perspective, what's going on kind of behind the scenes there?
Yeah. So when you are getting started, first you're going to have any lender is going to ask you to complete an application. Typically it's online. And so you just complete the application online. We typically check your credit right after that to make sure that's within a qualifying range, which for VA and FHA, you're looking at like a minimum of 580. For your conventional loans, potentially 620 or higher. I like to see for a conventional loan, I typically like to see a 700 or better, just because your pricing is going to be a lot better. But that's, again, things that we do behind the scenes of making sure that your loan matches is best for you. But then we just start gathering like your asset and income documentation. There is a difference between pre-qualified and pre-approved. So if somebody says you are pre-qualified, but you didn't give any documentation, and you just fill out an application and just based off of your stated income and all that kind of stuff, I would tread a little lightly, because the way you might think that you make $10,000 a month, but the way that the guidelines read and the averaging that we have to do, it could potentially be a little bit less. So as a buyer, you could potentially be putting earnest money or your money at risk. And so it's important to work with a professional that is very versed in the guidelines and could help you find the right program for you.
It's a really good distinction that you brought up there between being pre-qualified and being pre-approved, because a lot of lenders are just, as fast as they can write them off, handing out pre-qualification letters, and the pre-approval process is a little bit different.
It's a little safer.
Right.
It is a little bit slower, fastest isn't always better, sometimes if you're not first, you're not always last. So
True. You can be second, you can be third.
You could do all these things. Yeah. So we just check your credit, we do all that kind of stuff. And then it's basically, once you do get that pre-approval letter, it's like your VIP pass or like your golden ticket to start looking at homes. I know, Justin, that you guys always want to see, and sellers want to see that pre-approval in hand when they are looking, to look for a home, when they want to let buyers in the home.
Definitely. So once we've got that pre-approval letter in hand, and we're going to go out there and we're going to start shopping for homes, and we've found like the one, we're writing an offer and they have accepted the offer because we wrote such a good offer to begin with. Mm-hmm. What's happening kind of behind the scenes from that point forward?
Once their offer is accepted?
Yes.
So once their offer is accepted, you have a binding legal contract. Your wonderful realtor is going to send it to your lender and to the title company, and everybody's going to start doing things on the back end. That's that gets the ball rolling. It gets everybody moving forward to get you to the closing table. So on the lending side, we start to get everything prepped for underwriting. And so we do typically ask for maybe some updated bank statements, or every lender's going to want to see your earnest money coming out of your bank account. Make sure that's good to go. So we ask for updated pay stubs and updated bank statements, but we get that package ready for underwriting. all tied in a pretty bow for them, so that it's in hopefully a clean and easy file for underwriting and gets you clear to close. And then also when that contract is received, your realtor is going to ask, please get that appraisal ordered. So that's the next step. We get that appraisal ordered within our system. We send out to all of the appraisal companies in town. They are a third party. Appraisers don't work for a specific lending institution. They have to be a true third party opinion. So that it's basically what the appraisal is they're looking to make sure that there's enough collateral in that home that you're purchasing so that you are making a good investment.
Can you talk a little bit more about the appraisal process? Just because I think that there's a big misconception that, we've got to, or that we have some sort of power or some sort of like in with the appraisers that, we're gonna get this appraisal to come in either at or above value. And just as you were saying that they are a third party, we have zero control over this.
There's a lot of guidelines, there's a lot of laws around not having an impact on the value of that property. That used to be a thing. It used to be a thing if you could call Mr. like Joe Schmo appraiser and say, hey dude, I need this one to come in at this value. This is really important. Yeah, I got you, man. And it would happen. And that's not a thing anymore, which is great because it helps protect you as a buyer. And so what that is that appraiser, very much like what a listing agent does when they price a home out, is they look at your location, they look at your square footage, your bedrooms, your baths, the quality of your home, all these kinds of things. And they typically do a 6-month look back, and shorter if possible, but up to a 6-month look back to see homes that are similar to the one you're purchasing and what they have sold for. And so they make adjustments accordingly if it's a little bit older and stuff like that. But that's how they come up with their opinion of value. It's usually very close to the purchase price. Sometimes it's not. Depends on the market.
Yeah, really depends. Sometimes it's way above. Sometimes it's way below.
Yeah, and like I said, it's the appraiser's opinion. It's not an exact science. So it is their opinion of the value of that property.
Now, one of the things that, especially around the time of getting an appraisal ordered, that we're seeing sometimes is buyers have questions about why they're getting asked for their credit card for the cost of an appraisal. Can you talk a little bit about that? So
the cost of the appraisal is typically about $1,200. That was kind of set by the VA themselves. The VA is the one who upped their purchase or their appraisal fee during COVID, actually. So in the Fairbanks area, you're looking at about a $1,200 appraisal fee. Even if it's on the seller side of the contract, if the seller is paying for the appraisal, it is the buyer's responsibility to front the funds for the appraisal. At first rate, we do collect your credit card number. However, we do not charge your card. A lot of companies do charge your card, and then you kind of get that credited back at closing. We don't charge your card unless for some reason the deal doesn't close and there's an invoice that the appraiser needs paid. We just collect that credit card up front and then just have it on file until if it needs to be charged.
Okay, so it sounds like we can still, as we're writing up the offer, we can still ask for the seller to cover the cost of the appraisal at closing, but we're just asking the buyer to kind of guarantee, quote unquote, hold, put the appraisal on hold with a credit card for the time being, and have it paid for at closing.
Yeah, you shouldn't see the charge on your card at all.
Perfect.
It's just to get it ordered.
That seems easy enough.
Yeah.
Now, we were talking a little bit before we started recording about, and this kind of goes back about the pre-qualification versus the pre-approval process. Looking at the first 15 days of a transaction and being completely underwritten and being good to go and being approved, ready to go during that time. Could you talk a little bit about what that looks like, what that underwriting or that underwritten approval looks like in the first 15 days?
So once we get your updated documentation that we requested up front, we send your file to an underwriter. So a physical person is looking at your file, and they are basically doing what your loan officer, what I have done up front, but they're doing it with a little bit finer tooth comb, right? They're really making sure that everything in this file is following the guidelines of your loan type. And so typically it's about a 48-hour turn time. We're a broker, so some of our lenders that we work with have a 24-hour turn time. But we try to get that done as quickly as possible, like you said, to make sure we get that back within the first 15-day discovery period window. So for something that I didn't catch up front, we can't close, that you can get your earnest money back in front of their home for a property that you do qualify for. That hasn't happened yet, just so you know. But that's what they do. And so they look at the file, and then we'll get what's called, and you'll get an email saying, congratulations, your file has been approved. Typically it's a conditional approval. So you're approved based off of these conditions. And if you just have to give us an updated bank statement, I saw something on your tax returns. Can you just explain this real quick? Usually just like little things like that. A very, very normal part of the process.
Perfect.
Yeah.
So especially during that first 15 days, just because as we had kind of talked about, that's the discovery period. That's the time that we want to make sure that we've got all of our ducks in a row. We're getting everything back and forth to our lender, to anybody that's really asking for documentation. Because if on the 16th day we find something and we're like, oh, hey, sorry, we can't qualify. It's not looking good. On the 16th day, earnest money is in jeopardy.
It's important to just go back to our first point of the difference between a pre-qualification and a pre-approval. That's why it's important that your loan officer is doing a really good job up front, ensuring that they're protecting your money, and they're not just writing a pre-approval or a pre-qualification, but they're doing their job and making sure that they're really looking at your file in detail. Yeah, it's really important because the underwriter's going to. Somebody's going to at some point. It's better to do it now rather than later.
Yeah. The analogy that I've always heard, this could be wrong, maybe it is, maybe it isn't. But in looking at a real estate transaction, everyone is on, like, your realtor, your lender, your title company. Well, maybe not your title company, maybe the title company. Everyone's on one team trying to push everything through and saying, yes. This is everything that everyone wants. Everything's ready to go. And the underwriters and part of the title company is like, hey, no, we're going to tell you all of the reasons why we can't do this. Yep. And they're the brake and we're all the gas.
Yeah, I always like the analogy of we're all on a conveyor belt. We're all the same team on one conveyor belt, but every once in a while, like, one party will say, oh, hold on, we got something coming up here.
Slow down. And
a lot of times it's to protect the consumer, and sometimes it's to protect them for, also because they're making a huge investment. But it's all, we usually get to the closing table. Because
we've got so many people that are so ready to raise a flag anytime something is wrong, and we just take care of it and knock things out, that there are very, very, very few times when after the fact someone comes later and says, oh, hey, here's this problem that cropped up because it wasn't taken care of. Yeah. So that's what I really like about it.
Yeah, exactly.
So as far as after the appraisal comes in, or, what kind of things are we looking at? So appraisal comes in, and it also goes to the underwriter, because the underwriter is not only looking to see, there's really two approvals that are happening at the same time. It's you as the buyer, and then the property as well. So there's guidelines for both. There's guidelines on, can you repay this loan that you're saying you're going to repay? And is this property a good, safe, sound home for your family? Is it a good investment, essentially? And so that appraisal comes in, and that's what the appraiser is. She is basically the eyes and ears of the lending institution. And so they're looking to see what the value is. They're looking at the quality of the home. They're looking to see, there's pictures in there too. So when I say they're literally the eyes of the lending institution, they are looking at the pictures of that home. And they're looking to see, are there any health and safety issues that need to be addressed before they're willing to allow you to live in that property? Is there exposed wiring? Are there pipes in there that also are exposed that, a child could get burned on? Things like that. Are there smoke detectors in the house? Are the railings on the stairs too wide? Could a child fit through those things? So these are the things that the appraiser is looking for. They're not an engineer. They're not opening up walls or anything like that. They're really just making sure that, the home is really safe. It's really safe for you and your family. Yeah, they want to make sure that it essentially meets the guidelines for the financing and for the financing type that the buyer has. And they have safety guidelines. A lot of them do. So. Yeah.
And a lot of times the value will come in. I mean, the value comes in what it is, but a lot of times it'll say What it is, you get the value and then you get either subject to, so the value will come in at 365 if these repairs are completed. And then we just have to have somebody complete those repairs, and then you order a final appraisal. The appraiser goes back out and signs off on those repairs, and then you're much closer to the closing table once we get back.
Perfect.
Yeah.
And just because we're on the topic, if weather should keep us from being able to do some of those repairs, sometimes we can get escrow holdbacks. It's an option to kind of buy us some time to get us. Yeah, because of weather keeping us from being able to do some.
As long as they're not health and safety issues. Health and safety issues always have to be addressed. But if it's paint, like peeling paint doesn't dry at -30. So we just escrow for that for the spring. Yeah,
it does freeze, but when it thaws, it's useless. It's got a chip on you.
Yeah.
So.
Yeah, exactly.
The well and septic report. Can we talk a little bit about what our lender, what our underwriter is doing if we need one, and kind of what they're looking for?
Yep. So really, the one VA is the one that always has to have one. If you are not on city, if you're not on city, you don't have to. You don't have a well. You don't have a septic. Typically, sometimes you're on city and you have a septic, but you're not typically. So we don't need that for those purposes. However, if you are, most of the homes in the Fairbanks North Pole area are on a private well and you have a septic. And so those have to be tested. So we test the well for E. coli and total coliform. And so that's, again, for your safety. And therefore, if they are, when I bought my home, it did test positive. So it just had to be treated. And it was fine. We still got to close and the home has been fine ever since. Your septic is tested through, your professional go out there and really they're checking the flow, and they're also checking to make sure that the capacity is large enough for the number of bedrooms in the home. So you're not going to have anything backing up.
Perfect. And with it, if it does not meet the standards, that are in place, more often than not, that's tends to be something that the seller is going to have to remedy in order for them to sell to somebody that has that kind of loan type. Is that right?
Yeah. So a lot of times it just has to be, a lot of times pumping the septic is called out. It's too full. So that's very normal. You're supposed to get your septic pumped every year to every other year in the Fairbanks area anyway. And also they check the distance. So sometimes it has to be moved. Sometimes somebody put it in and they put it too close to the well. So there's a possibility of cross-contamination, which is a big no-no. And so, we replace septics, not we, but septics are replaced all the time. Yeah,
it's a year-round endeavor, unfortunately. Okay, I don't think we've got any more to touch on when it comes to well and septic stuff.
Yeah, that's about it. Again, just one step closer. Sometimes those delay things depending on how long that septic takes to get replaced and all of the professionals and the DEC paperwork.
If temperatures get to, I think, 10 below, they won't dig in the dirt just because it's so hazardous for the machines. Yeah. But apart from that, they can do them year round.
Put it on property, I think.
Is it? I think that apart from that, we'd be looking at like closing disclosure stuff.
Yeah. So once we get numbers, and we do send our closing disclosure out fairly early in the process, it does have to be signed. Your closing disclosure has to be signed at least a minimum of 3 days prior to closing. So we do try to send that out. You know your numbers. You should know your numbers ahead of time. Your lender should be chatting with you about them, sending them up front so you have an idea of what your interest rate is, what your monthly payment's going to be, and what your estimated cash to close. Things change throughout the process, so your cash to close can change. That's why it's an estimate. You don't have your homeowner's insurance at that time, so the numbers that your lender uses is an estimate. And then also, we haven't balanced with the title company yet either. So once that stuff is done, actually the closing disclosure is done prior to balancing with the title company. So even though it's still a very official document, it's still just a estimate also. But that gets sent out to you. Just kind of what that is just outlining the terms again of your costs, right? Like I said, the loan amount, the interest rate, the monthly payments, and your closing costs. Do look at it, and if you have any questions, just call your lender and see what's going on.
Can you talk a little bit about what the closing disclosure is?
That is, it looks like a cost estimate basically, and it's a very confusing document because it doesn't necessarily show what is on the buyer side, what is on the seller side. So you really want to look, page 1 is going to show you your purchase price, your loan amount. It's going to break down the principal and interest portion of your payment. And then it's going to tell you what your homeowner's insurance and taxes. You should have your homeowner's insurance by that point in time in the game. So it's going to break that down and how that adds up to what your monthly payment is, your principal, interest, taxes, and insurances that you're going to pay to your lender. And then on the bottom of that page 1, it's going to tell you, it's going to give you 2 numbers. This is where it gets confusing. It's going to tell you the total cash to close, which is all the cash that's ever involved in this transaction, including the seller's costs. It's going to be, might say $56,000, and that scares a lot of people. But you're going to want to look at the cash that you need to bring to the table, and that's the second number. Or it's on page 2. Page 2, then it's going to break down all those fees. You're going to look at lender fees, discount points. Does your lender charge any underwriting, processing fees like that? We do not. But then it's also going to break down the title fees, the appraiser costs, your escrow, how many months of taxes and homeowners insurance are they collecting, things like that. It's going to include your earnest money. It's going to include your down payment, and it's going to include any seller credits or lender credits too. And that's going to be at the bottom right corner of that page 2.
But it also shows interest, the total amount of interest that you end up paying. Is that?
It does, yes. So that's on the almost the last page. It'll tell you is your loan assumable. It'll tell you your APR, and it'll also tell you how much interest you're going to pay on the loan in total if you don't make any additional principal payments.
Yeah, that's one of the things that when I'm talking with folks about it, I say, yeah, it's essentially going to be a really long packet of paper that's going to tell you a bunch of scary stuff, but it should be all of your same numbers.
Yeah, they should be very similar numbers. If they're drastically different, that's when you just pick up the phone and call your lender.
Mm-hmm.
Say what's going on, why do these look so different?
Now, after we've signed the disclosure or the closing disclosures, these like horror stories that lenders will tell about, or not lenders, I'm sure lenders also tell them too. I know they do because we've talked about them before. Of people going out and being like, all right, I'm going to buy, my house is going to be closing on Friday. I'm going to be moving in on Saturday. I better go get some furniture. I'm going to need to go get all this stuff. And they start talking about financing stuff. Can we talk a little bit about what that looks like on the lender side when people start to go out and
really good
financing things?
So just because you're close to the finish line doesn't mean you're there yet. So lenders don't do a full credit check. It's not a hard hit, but they do a soft pull right before closing to check to see if you've had your credit checked. If you have had your credit checked, they're going to ask you, what is this? And did you open any new lines of debt? And I've had it. People have bought vehicles in the middle of the transaction, and it's, vehicles are expensive. So it's a $700-800 payment, and they no longer qualify for the home. So they just lost the home that they wanted to live in. They've lost their $5,000 of earnest money because they bought a home and they could have just waited 10 days. And so it's important not to get, don't finance anything new until you get the keys to your home, to include furniture to put in your home. Yeah.
Even if it's 0% financing, it's still 0% chance you're going to be living in a house.
Yep. Exactly.
Okay. I'm glad we talked about that. Doesn't happen all the time, but when it happens, it's painful.
So once you get your closing disclosure signed, the appraisal's in, the final appraisal's in, well and septic report is in, you've given all the documents to your lender that they have asked for your conditional approval, then the file gets submitted back to underwriting for final approval. And then hopefully at that point in time, sometimes the underwriter comes back and asks for a little bit more just because new questions have come up based off of the new documentation that's provided. But hopefully you get clear to close. You get final approval, then clear to close. And what happens at that point is that everything at that final stage, right? That's the final stage of when the lender gets the documents over to the title company to begin balancing. They begin balancing your numbers back and forth to get those final numbers. And you'll hear from your realtor of when you can schedule a time to go to the title company and sign your documents. So you're very, very close to getting your keys and having your own home.
Once we've signed, it's like the next business day, we're typically recording.
Yeah, exactly. And you get your keys the next day. It's a little odd that you walk away from the title company in Fairbanks without your keys, but you do. Go sign, walk away, and then the next day you get a call and say, we recorded, and all good news, you get your keys, you get to move in.
Yep, and we're all done. So after everything's recorded, what's the what does everything look like on the back end for you guys?
On the back end for us, the good news about buying a home is, let's say you record in November, your first payment is not until January. So you get a little bit of grace period there. If you have a rental and you need to move out, you don't have to double 2 payments at the same time. But your payments due the 1st, not wait until the 15th, but make it on the 1st as much as you can. But you're going to receive information from the title company at that closing table of where to make your payment. And then you can just go online. You should have your loan number. It's going to ask you for your social, just so that it's your account. When you log into the lender's website, if you want to set up auto payments, you can set up monthly. Most of our lenders allow for biweekly payments. Making an extra payment, a year is going to typically take your 30-year mortgage down to a 20-year mortgage. And so there's no prepayment penalty on your loan. So paying it off a little bit sooner, paying a little less interest on that is a good thing.
Right on.
Yeah, get your utilities switched over, all that stuff.
Yeah, that's an important one, is to make sure you're contacting all, utility folks, especially the day that you're supposed to be recording.
Yeah.
If you don't get power turned on, then your seller very well could get power turned off for you.
Yeah,
and then
if I'm not mistaken, it's a little more expensive sometimes to turn it off and back on as opposed to having it transferred.
Yeah, it doesn't cost anything to have it transferred, but if it gets shut off, it's a couple of days to wait, and it could very likely cost about $50, I think, to have it turned back on. And with it,
I like to save $50 if I can.
Yeah, and if you can avoid possibly having power off over a long weekend in the winter, you want to keep heat in your house.
Thinking about moving to Fairbanks? Well, click on the link below for my free relocation guide, where I talk about top schools, top neighborhoods, and so much more.
Thanks again, Bethany, for joining us and talking with us a little bit about the lender's perspective through the home buying process. I think that definitely answered a lot of questions that I know people have, because I've talked with them and tried to fumble my way through it. So thanks again for walking us through that.
Thank you for having me. I appreciate it.
As always, we've got Bethany's information in the description below. If you've got any questions at all about getting pre-approved or real estate in general, you can give us a call, 907-885-0316, or you can reach out to us on our website, www.fbxhomesearch.com.
Okay.
Thank you. Have a good day.